Data just dropped, and it's not rumor, it's official exchange policy. SHFE, the Shanghai Futures Exchange, just announced that starting the last day of February, any participant without a hedging quota will get 0 lots of physical delivery on all silver contracts. 0, nothing, no allocation. That is the exchange openly saying, if you're not a recognized commercial hedger, you're not getting metal out of this system. Admitting physical tightness like this is extreme. This is not how a market behaves when there's plenty of silver lying around. OG John. AG here. Let me be absolutely clear before we go further. I will never ask you for money. No paid signals, no courses, no mentorship programs, no invest with me. If you ever see my name attached to anything trying to sell you a product, a group, or a trading service, it's a fake. Report it and move on. I make these videos for one reason. Truth matters. This is financial warfare education, not financial advice. Protect your capital, verify everything, and stay far away from anyone promising easy money in markets like this. Quick housekeeping for those who missed the last 2 uploads. We've talked about the shadow ban, suppression this channel's been dealing with, reach throttled, notifications delayed, search visibility cut. If you haven't watched those videos, go back and do it. They explain exactly why you might not be seeing every upload in your feed. More important, there is a backup channel. Handle, OGJohnAg2. Link is in the description. Right now that backup has 0 videos. That's how you know it's the real one. Anything else using my name with random uploads is a clone or scam. Verify the handle before you subscribe. This is not optional. If they hit this main channel harder, that backup is the vault. That's where the message continues. Deeper, harder, with fewer limits. If you're getting value from this breakdown, drop a comment. It doesn't have to be long. I'm here or still watching, whatever. Yesterday, around 30,000 of you pushed back when they threw bots, clones, and algorithm games at this channel. You turned a suppression attempt into a wave they had to acknowledge. That's how these systems break, when people move in sync. Now let's get back to the data. Segment 1, East versus West, pricing. The premium is screaming. Here are the numbers as I'm recording this. Western spot silver, about $85.90 per ounce. Western silver futures, around $85.40. Shanghai spot, about $89.67. Shanghai futures, roughly $92.29. That's about a $377 premium in Shanghai over Western pricing for the same metal. You can pull SHFE and SGE quotes yourself. This is all public data if you're willing to actually look. A persistent $3.04 premium means one thing. Physical in the East is valued higher than paper in the West. That gap is the market quietly telling you paper and physical are separating. Now layer in the recent price action. In just the last 12 hours, silver has surged another 7 or 8%, adding roughly $297 billion to its total market cap. From last Friday's overnight lows, around $63.90, silver has already regained about 35% in 5 days. Think about that. 35% recovery in less than a week, on top of already crazy volatility. You do not get that kind of behavior in a market that's comfortable and well supplied. You get that in a market under structural stress. While that snapback was happening, SHFE wasn't just sitting there. They suspended 3 more groups of accounts today for trading violations. Total in the last week, 20 account groups suspended on a major global futures exchange. 20 in 7 days. How often do you see that? Go read Article 16 of the SHFE regulations. It's all spelled out. The rulebook for sanctions, restrictions, and suspensions is in black and white, publicly available. The people who actually pull that document and read it know exactly what this cluster of suspensions means. The people who shrug and don't check will figure it out later, at higher prices. Segment 2, Comex coverage. 3.4 paper claims for every 1 ounce. Let's flip over to the western side and talk Comex. Yesterday alone, about 861,000 ounces of silver left Comex registered inventories in 1 day. At the same time, March contracts are being closed and rolled forward at an accelerated pace. If that rolling continues at this speed, Comex might have enough silver for March delivery. But that might rests completely on the assumption that contract holders keep choosing paper rolls over physical metal. Now look at the structure. Current open interest, roughly 68,000 contracts. Each contract represents 5,000 ounces. That's about 340 million ounces of paper silver claims. Registered silver actually sitting in Comex vaults, around 101 million ounces. Do the division, that's a 3.4.1 coverage ratio. For every 1 ounce of registered metal, there are 3.4 ounces worth of paper claims attached to it. This isn't a secret. Comex posts this data. It's dated, verifiable, and free to download if you take 5 minutes to look. On top of that, open interest dropped by about 2,000 contracts, which suggests some mild short covering. Shorts buying back to flatten risk into this volatility. So, to summarize the structure, East, premium over spot, delivery restrictions, account suspensions. West, 3.4 paper claims per ounce, vault metal bleeding out. The plumbing is telling you the story, even if the headlines don't. Segment 3. Bloomberg and mainstream finally say the shortage word. You don't have to live on alternative media to see this anymore. Even Bloomberg is starting to slip the truth out between the lines. Recent coverage out of Hong Kong. Gold demand surging ahead of Lunar New Year retail, buying small bars and coins as gifts. Trading volumes up sharply versus last year. Standard festive demand story. Until one line. Supply constraints, especially in silver, are raising concerns about whether the momentum can last. Read that again. Supply constraints, especially in silver. From Bloomberg. Not a blog, not a Reddit thread. Mainstream financial media admitting on air that silver shortage is real, just burying it mid-story where most people won't notice. Bloomberg then published a piece explicitly on China's big silver squeeze continuing even as prices stabilize. That means the East is still pulling physical. The squeeze dynamic hasn't gone away. The everything is fine narrative is cracking even in polite media. If you actually read past the headline, the signals are all there. Segment 4. David Jensen's depletion analysis. You haven't seen anything yet. Analyst David Jensen put out fresh work on silver depletion, and his conclusions line up with everything we're seeing. His key points: Western vault stocks of silver, New York, London, etc., are in rapid decline. Silver lease rates on US and London exchanges have spiked and churned, signaling stress in the system. Metal is flowing eastward, not just from Comex or LBMA, but from vaults globally. All major vault complexes are drawing down simultaneously. Add in the long-term fundamentals. Decades of overconsumption and underproduction structural deficits. Demand consistently above supply. Means that bringing new supply to market will require much higher prices, not a small tweak. His line on volatility. People are worried about how fast silver has moved and how wild the swings are, but they haven't seen anything yet. If you want to vet that yourself, his full analysis is public and he cites his data sources. The people who take the time to read it are positioning early. The rest are waiting for TV pundits to explain it to them comfortably. Segment 5. Geopolitics, decoupling, export controls, and the Shanghai premium. Let's connect this to the bigger geopolitical board. China's share of US imports just hit a 26-year low. For about 5 years straight, China has been actively decoupling its export engine from US dependence. So this idea that the US can crush China now with broad export tariffs is disconnected from reality. China has already rerouted huge parts of its supply chains. What is China doing while decoupling? Implementing export controls on strategic metals, hoarding key inputs, allowing a persistent Shanghai premium to develop. Today, that premium is about $3.77 in silver. That premium is a scoreboard. It shows that physical in the East trades richer than Western paper claims. It's the market itself saying, we don't fully believe the Western screen price when it comes to actual metal. You can verify Shanghai premium data on the Shanghai Gold Exchange, SHFE feeds every day. Again, public, trackable, not hidden. Segment 6, silver versus gold. Tighter metal, more essential, more violent. Here's what the data says about silver's role versus gold. Economically available silver versus gold is estimated around 1/100, meaning in accessible form, there's far less silver relative to how dependent our systems are on it. Society's dependency on silver, solar panels, EVs, AI data centers, 5G networks, military electronics, far exceeds gold's role in daily infrastructure. Gold is primarily monetary and a store of value. Silver is monetary plus industrial. At the same time, silver's supply situation is tighter. More of it gets consumed in forms that are hard to economically recycle quickly. Mine supply growth is sluggish. Byproduct dependency means you don't get neat, clean production responses to price. People aren't rotating into silver because they're bored of gold. They're rotating because silver's percentage returns are crushing gold's in this cycle, both up and down. The disconnect: screens in New York still show a spot price, but the real price is increasingly whatever it takes to get delivery, clear premium, secure metal when you actually ask for bars, not cash settlement. That's what SHFE delivery restrictions, Shanghai premiums, and global vault drains are signaling. The paper price is drifting away from the physical reality. Segment 7, big banks. Bubble warnings versus higher targets. Even the big houses are split. Bank of America's new bubble risk indicator flags U.S. material stocks, gold, silver, and South Korea's KOSPI as showing bubble-like behavior. They're warning that AI-driven innovation can fuel more unstable, bubble-prone markets, including metals. Same time frame. Wells Fargo raises its 2026 gold target to about $6,100–$6,300, which is more than 20% upside from here. Their rationale: geopolitical risk, market volatility, strong central bank demand. They call the recent 10% plus pullback in gold a healthy correction after a big run, not a blow-off top. So in the same week, one big bank. Bubble risk in metals, another. We see more upside. This is a buyable correction. That's open institutional confusion. When the models can't agree, the system is at a turning point. Also, zoom out. The S&P 500 versus gold ratio has been in a 25-year bear market, down about 60% over that period. Decades of tech innovation, record corporate profits, all underperforming a metal that just sits there. The S&P's earnings yield is scraping near 100-year lows, only seen lower at the peak of the dot-com bubble. So maybe the bubble isn't metals. Maybe the bubble is in financial assets priced in devaluing currency, while metals are just repricing that distortion. Silver, with tighter supply and dual use, is simply the more violent expression of that same theme. Segment 8. The honest bearish case. We're not doing hopium here. You need both sides. Bearish-caution points. 1-month silver lease rates recently cooled back toward about 2.7% after ripping higher with 4 to 6% daily swings. That kind of snapback can indicate that some of the immediate squeeze pressure eased, or that some short-term stress was unwound. If Comex March rollovers continue at the current pace, there may be enough registered silver to handle March deliveries. We've seen doomsday delivery fears before that didn't materialize because enough traders rolled or closed. The Shanghai premium at around 3.77 is elevated, but not the highest in history. We've seen fatter gaps in past cycles. It's not completely unprecedented. Bank of America's bubble warning isn't meaningless. Assets that go too far, too fast, often correct hard, regardless of good fundamentals. And then the big one. JP Morgan paid about $920 million in 2020 to settle precious metals manipulation charges, proof that these markets can be steered and suppressed for long periods before the system even blinks. They were at it for years, paid a fine, and the desks went right back to business until the next issue. So if you're expecting instant justice and pure price discovery tomorrow, you're dreaming. Paper markets have tools, concentrated shorts, derivatives, central bank coordination, that can hold lids on price longer than most traders can stay solvent. All of that is real. That's the delay mechanism. Segment 9, the core. Physical versus paper is where the assumption breaks. All those bearish factors rely on one assumption, that paper markets will continue to control price discovery. SHFE's new rule, zero delivery allocation for non-hedgers starting end of February, directly challenges that assumption. It says, we will decide who gets metal. If you're not a real hedger, you're in the casino only, not in the vault. Combine that with global vault depletion. 20 SHFE account group suspensions in 1 week, persistent Shanghai premium Bloomberg admitting supply constraints in silver on Air Comex at 3.41 paper to metal coverage. These are all signals that physical is peeling away from paper. You can print infinite futures contracts. You can create infinite structured products. You can write synthetic exposure until your servers melt. You cannot print physical silver. Once enough players demand, no cash settlement, no roll, deliver my bars, then the entire pricing machinery gets exposed. That's the setup forming right now. Segment 10. What kind of player are you? Here's where you need to be honest with yourself. If you're hoping someone will step in, fix manipulation, ring a bell and say, now it's safe, you're in the wrong game. The data is public. SHFE delivery restrictions, Comex, coverage ratios, Shanghai premium Bloomberg articles, vault depletion analysis, bank forecasts, and bubble warnings. You can verify all of it, or you can ignore it and wait to be told what happened in a Netflix documentary 10 years from now. I'm not here to tell you what to buy or sell. I'm here to tell you this is financial warfare. Price, policy, and narrative are all weapons. The split between paper claims and physical reality is widening. Those who check the primary sources and act with logic, not emotion, are early. Those who refuse to look will be late, and they will be told nobody could have seen it coming. You're literally watching it come. That's it. SHFE choking off delivery to non-hedgers, Shanghai premiums, Comex at 3.41, vault drains, mainstream admitting supply constraints, all happening now. Protect your capital. Verify everything yourself. Invest with logic, not hype.